Let me be clear. I don't want to see people suffer, but I do think a recession is coming. A very big one. The writing has been on the wall for years. I'm not causing it to happen, but I might as well be prepared and profit from it. I'm not alone. Other people have used recessions as opportunities to get rich. Maybe you should too. First, let me show you why I think a recession is on the way. Then I'll explain how you can capitalize on it. The yield curve. It's actually one of the strongest recession predictors. This one looks at the 10-year bond and it compares it to the 2-year. In normal circumstances, the longer-term treasuries are going to have a higher interest rate than the shorter-term ones. That just makes sense. If you're going to lend money to the government for a very long time, you're going to want a higher interest rate. But sometimes it does the opposite, where the short-term treasuries have higher yields than the long-term ones. Anytime this line goes below the black line, that means the yield curve was inverted. And we can see a pretty clear pattern with this. You see an inversion of the yield curve, then it uninverts, and then you have the recession. Let's see again. When does it invert? Did it briefly here, but it really did it here. It inverted, uninverted, recession. Again here, inverted, uninverted, recession. Briefly here, it's clearer if you compare the 10-year to the 3-month. It inverted, and then uninverted, and recession. Look right here. Clearly, deeply inverted for a significant amount of time. Uninverted. The recession should be very close. This gives you a rough sense about the timing of a recession. Doesn't exactly tell you how deep it could be. If you want to look at that, let's look at the valuations. The Shiller PE ratio, it compares the stock prices of the S&P 500 to their earnings. So it's a price to earnings ratio for the S&P 500, essentially. And this data goes back to the late 1800s. The higher the number is, the higher the price is relative to the earnings. So if you're going to buy stocks, you want it to be a lower number. The median is 16.05. Right now, we're at 39. We recently crossed 40. This right here is the peak in 1929 before an 89% stock market crash. The Shiller PE ratio at that time was about 31. Today, we're above that. That is a little concerning, no? So you have the timing of the yield curve, and then you add the valuations, which tell you about how severe the recession could be. In other words, how large of a stock market decline it could be. Now, if the recession happens like I think it's going to, we could see a major decline in stock prices. Just to get back to the median Shiller PE ratio, we should see about a 60% decline in the S&P 500. That's just to get to the median. Usually it goes beyond that. And then sometimes earnings even decline. So I wouldn't be surprised to see maybe a 70% crash, maybe more. When the dot-com bubble burst, we saw about a 77% decline in the NASDAQ. So if we see a major recession and market crash, this is where the opportunity is. Basically, all assets become hugely discounted. It's like a fire sale. Real estate, stocks, businesses. It basically starts raining gold. And Warren Buffett said, when it starts raining gold, get out the bucket, not the thimble. So let's talk about how to prepare for that kind of situation. For when it starts raining gold. What you're going to want to have at that time is cash. A few years ago, people would say cash is trash. When inflation was running hot, you wanted to buy assets. But in a major recession, that's when they say cash is king. But that's when it's hard to come by. So it makes sense to accumulate the cash before the crash. I'm not a financial advisor, so I'm not going to tell you what you should do. But for me, I like the idea of treasury bills. It gives you the optionality. It's very liquid. It's a temporary measure. I don't recommend holding on to T-bills forever. But if there is a crash, usually these T-bills are going to be safe. You know, anything can happen. But I think Warren Buffett knows what he's doing. And his company, Berkshire Hathaway, is holding over $300 billion in T-bills and cash. That ought to tell you something. So if you're looking at the stock market right now, just continue hitting all-time highs. Maybe try to resist that FOMO urge. And if you want, you could sell stocks and start stacking up the cash. If you want to do that, you can. Another way to prepare is something that I've done that I really don't recommend. That's shorting stocks. I used put options, long expiration, deep in the money put options against 5 stocks. I put in $614,000. I really do not recommend this. It can be pretty stressful. While I have a long expiration and I think it'll work out, it's been a long ride. I've been shorting since May of 2022. I do not recommend it. It can work out particularly well if there is a crash, but these are notoriously hard to time. As I showed you earlier, the yield curve is showing that the recession should be near. It's not guaranteed. I could be wrong. And if you sell now and I'm wrong and the market continues going up, you're missing out on those gains. But if I'm right and you're holding that bag, it may take you a very long time just to break even again. If you hold on, stock prices eventually are just going to keep going up. If you have a very long time horizon, you should be okay. But if you want to take advantage of potentially one of the greatest opportunities in your lifetime, maybe, I think it's better to start preparing sooner rather than later. I'm currently positioned in an extremely bearish way. I have a massive short position that I have been starting to trim, but it's still pretty big. I'm also stacking up a large amount of treasury bills and cash, over $1 million. So if this recession does happen, like I think it's going to, and we have a giant crash, I'll be ready. Don't say I didn't warn you.